Hey guys, it's Max. How's everybody doing? Um, I got a question and I was trying to answer it, but it just takes too long to write. I'm better at talking than I am writing. I need to have a video follow up on some of these option trades I've been showing you guys. I made a video the other day and I showed you a trade in Google and Spotify. I recommended the trade in Google and I did the trade in Google in real life, didn't do the Spotify trade in real life. Well, the Spotify trade hit. The Google trade Google's going to open down this morning. That looks like that one probably going to be a loser. Then also I did AMD in real life. Now I didn't make any content about AMD. AMD is also down. I can't control whether they go up or down, of course. I'm trying to extract my edge over time. By moving the theory of the loaded dice and the trade I've been doing lately every time is just the bullish loaded dice where I move the break even as far down as possible and put a single call out there, sell two put spreads to buy a single call, do the whole thing for a credit. It's basically, just think of it like a put spread, kind of with a YOLO call on the end of it in case you have an outlier move up. But the rest of it's just selling a put spread. But because it's a put spread and puts are priced really rich right before a company reports earnings, you can lots of times slide it. You can slide the break even 5, 6, 7% down. Now, what's going to happen in the case of Google? Let's take a look at some of these. Anyway, but I got a question, and I didn't get the person's name. I'm sorry, but I got a question. Somebody's watching my earnings videos. I have an earnings video fan. I'm obsessed with these. I'm trying to find some people that like this as much as I do. I could give out. If I just wanted to make money, I should probably give out Max's best option trade of the day and go through and find the trade that's most likely to make money on that day, that one trade. I'm trying to make money over the course of an earnings season. Haven't been doing very well lately in my own account, although I had a gigantic win last week. And I had JP Morgan the week before that. But I've given back the profits this week, some of them. In any event, all right. Well, let's get into the middle of some of this. So I didn't plan anything. The reason I called it, I was going to call this a pod. Yeah, I did call it a podcast, Morning Option Talk podcast. So I don't have anything planned to say, and people are going to, and I'll inevitably get a bad comment. Well, that's fine. All right. So let's look at the market. So what is it? It's Wednesday morning. I haven't even looked at GPTY and ULTY and LFTY yet, but I'm going to look at options this morning. I'm not as interested in those. I love those ETFs, but I'm more personally interested in the option strategy side of it. But those option ETFs are a freaking godsend for somebody that doesn't know how to do all this themselves, but still wants income, and they're great for learning. It's been teaching a lot of people how to trade. There's people that are copy trading these strategies, including me. My earning strategy is actually came from a Netflix trade that Jay did in Alti, and Jay hit that trade big in Alti, but he sold a put spread and then bought a call spread. He didn't buy a single call, but he sold a put spread to buy a call spread in Netflix, and it set off whatever in my head where it goes ding, set off a bell. I was like, that's a good trade. And I never thought about doing it that way. But I've been doing earnings trades for years where I'm long one company and then hedge it. Or sometimes I just do regular option trades. I mentioned in 2022, I would get long Apple and hedge it with Microsoft or vice versa. I'm obsessed with pairs trading. But yes, my trades have not been working out great this week. All right, so let's go to, I guess, option strat. I didn't even know where I was going to go to. All right. One thing is the market's down this morning. The NASDAQ's going to open down 150 points, it looks like. So let's see. So the Spotify trade worked out great. I wish I would have done that in real life. I hope some of you guys did. I did the Google trade in real life, and it's staying down 161, but the results aren't back yet. Well, that's a bearish Google trade. I wish I would have done that one. I was just showing you guys you can do the same thing from a bearish perspective. You can do a bearish loaded dice and slide the slide the break even as far up as possible. It's the same thing. You're selling a call spread to buy a put spread. You have limited risk on the downside. I love that trade. I love that trade. That's a great way to play an earnings miss. And if it's a bad miss, and we've seen them before where they miss and they're down 17% the next day. Let's see what Google's going to be down this morning. I got too many damn tabs open. I just need to shut my tabs. Jiminy criminy, look at that. From 206 to 191. That is a bloodbath. Okay, well, let's go back and see what I did. That's where the risk is. When you sell a put spread, you're betting that you're essentially, when you sell a put spread, you're essentially buying the stock. You're synthetically getting long the stock. So that sucks. That means, that's how the other side wins if the price goes down. So it was called, I do so many of these, but the only one that counts is the uber bullish one. That's all I'm looking for. I want a chance at a ton of upside. I'll cover the downside with something else. Or I'll try to. It doesn't always cover it. Okay, now this is ridiculous. Okay, neutral loaded dice, put hedge roll out. Uber bull loaded dice Google. Yeah, I should have taken it off before earnings. It was up $198 before the end of the bell yesterday. I should have, anyway. But that's not the trade. The trade is you go through earnings because you hope the catalyst causes, oh no, we're up 15% this morning or something. That's what you're playing for. Or, oh no, they missed and we're down 4.5%. Oh, that sucks. Are you serious? That's too bad. Okay, well, this morning they're going to open where? Around 190. So it's right on the edge of the break even. The break even is actually 191. Sometimes the market will rally. It'll be a really bad open, but then they'll rally up during the day, and maybe this trade will be all right. All you're really trying to do is hold on to the $241. That's look at this as two separate trades. First of all, let's remove. This is kind of interesting. This is the way that Jay did it. That's the way Jay did it on Netflix. And I do it that way sometimes too. You can get a bigger credit that way because you sell an extra call out here. You no longer have unlimited upside, but it's still pretty high all the way to this. It's going up to the second standard deviation. And you aren't going to take it all the way anyway. Most people, they hit and they make it and they take it off down here for $400, $500, $600, $700, $800, $900. If they miss, like it's going to today, and it opens at 190, what we're going to do is we're going to hang on. We are already, we're in the, I'll explain why. From a game theory standpoint, we're definitely going to hang on because we've already lost all the money we can lose. Not really. I guess if it opens at 190, yeah, we're down 500. Okay. But if it stays at 190, we're actually down 200 or something. If it rallies a little bit, it might be back in the zone. What I do as soon as I put on a trade, I rarely sell to save any money. I consider that $1,700 gone. As soon as you put on the trade, whatever your risk is, like for instance, I'm switching gears here, but let's say we're buying call options. When I buy a call option, I spend $1,000 on it. If I'm wrong, I never take it off. The premium is my stop loss. Okay. And a lot of people disagree with that, but when you, just from a game theory standpoint, when you buy an option, your loss is limited when you put it on, and that's all you can lose. I just assume the money's gone. I budget it as if it's gone. What some people do is they spend, and like I might buy $1,000 option and I budget it if it's gone. Okay, if I think the SPY is going to blow up by Friday, I'll spend $1,000 on SPY options. But if it doesn't, that was my stop loss. It was $1,000. Other people might spend $10,000 on Thursday on SPY options. They don't get the move they want and it pulls back and they're down $1,000. They might cut the trade loose. They might lose the same $1,000 I did. I just believe in putting it all on the line up front and letting it go, because there's lots of times those people cut it loose and then it comes back. Now the opposite's true whenever you sell an option. From a game theory standpoint, a sold option, let's remove this. Well, when you sell an option, the opposite's true. You want to take it off quick lots of times. So that using that theory maybe means we should take this off at the open. So let's stick with this. What did I do with those? Gosh darn it! You got to be kidding me. Well, I'm just gonna go back to save trades because I didn't save it. Okay. When you sell an option, you can only make a little amount of money. You can only make $241. That's why I was having to take this off. That's if you don't know how to do the three-leg risk reversal. That's if you aren't watching max convexity. That the normal person can't make any money off a put spread, can't have any unlimited upside. So when if you're just a put spread seller, let's say you go by, so time goes by. Let's say the market moves down. Say the market moved to 195 by Thursday. So we'll just go there. Okay, 195 on Thursday. So there's 195 on Thursday. Okay, well, I'm not doing a very good job with my example. Let's say the market's at 200 on Thursday. That's a better example. Okay, the trade's up $250. Okay, well, how much is the most we can make? The credit, $350. So we only have $100 more that we can make in this position, and we have one more day. If something should happen and the market should tank, we have our max loss is $1,600. If something, some black swan hits the market. When we sell options, you want to take it off usually when you've achieved half your goal. So if you sold this spread for $350, Tasty Trade will tell you to take it off when half the time has passed or when you've got half the money. And that makes a lot of sense from a game theory standpoint, because when you can only win a little bit more, but you can lose so much more. When you buy an option, you put yourself in the opposite stance. Okay, so watch this. I'm going to exclude the put spread, and I'm just going to assume we bought a single call. This is another way to play earnings, just buy a darn call. It's not a very great way because calls are overpriced, especially prior to earnings, but it's a way. So if you want to just YOLO earnings, I think this damn thing's going to hit earnings. I'm not going to listen to Max. I don't care about selling something to get a profit. I don't care about a buffer. This thing's going to hit it and blow it out. All right. Well, you can just buy an option. Okay. Well, so let's make the math the same. Let's remember the other one, you had a $300 credit you were trying to make in that last example. Now we're going to spend $300 buying a single option in a different example. All right. In this case, let's say we go the same thing. Let's say we go to Thursday, the price is at 190 or 200. Okay. Well, this trade's down 325. Well, that's not a very good example. Let's say we even go into Monday and the price is at 200. Okay. Let's say we're at Monday, the price is 200. Well, gosh darn it, I'm down $200. I spent $300. There was a $300 debit to put this trade on, and I'm already down $200. What am I going to do? I'm going to take it off. There's still $100. I could get $100 back if I took it off right now. That's true. You could take that off. You get $100 back. Absolutely. But you see where I'm going with that. You only had $100 more to lose. You could only lose $320. You're already down $230. What's $100? That's the worst case scenario. Okay, I'm going to lose $100 more if I don't do anything. Okay, well, but you have the possibility of unlimited upside. You have a black swan on the other thing. So what I'm saying is I will invest amount. When I'm buying calls, I will spend an amount that I am comfortable with losing and make that my stop loss. that you're, to consider the money gone when you do it. Okay, but anyway, now back on the subject of buying and selling them at the same time. What I'm trying to do here with this three-legged risk reversals is a smarter way to kind of do both at the same time. So let's back include everything, include, and include. I made an hour-long video yesterday where I gave out a trade, and then I decided not to air it, and I'm so glad I didn't. It was another trade besides Google that lost. Anyway, you guys don't know about it, but of the trades I've given you guys this week, I've given you Spotify, that was a winner. Google, that was a loser. Planeteer, that was a winner. And then PayPal, that was a loser. But then one of our put hedges, the one we put on Friday, we came in Monday morning because the market was down 3.5%. That thing was worth $358. So we took that off and started the week with a profit. But we're going to add up the profit from those 4 trades that I just mentioned. Plus I still have these puts on. We're going to see how we come out at the end of the week. See if I make money. I don't know. I'm trying to express an edge over an earnings season. But over any one week, it just depends if the stocks cooperate or not. I just figured the stock is going to miss by 10% or make by, the stock's going to do what it's going to do regardless. I try to construct some type of strategy prior to the announcement that puts you in the best position you can be in, the best position you can be in. You have an income, a buffer, unlimited upside. I wish they made a fund like this. Oh, they do. It's called YMAX. The YieldMax does a similar strategy where they're doing synthetic covered calls. Well, synthetic covered call has a buffer and has a chance of upside, but since they're doing, or it has no chance of upside, but it has a nice buffer and it has an income. Well, since they're doing a synthetic covered call spread, that's where I got this idea. I'm just copy trading Jay. A synthetic covered call spread has the same risk reward graph pretty much as my 3-legged risk reversal. I'm just trying to find the 3-legged way is a more efficient way to do it for a small account. But anyway, in my opinion, we'll ask Jay about it. Jay's going to be on the show here. Oh, that reminds me. I need to get back to Jay's secretary. She emailed me last night, but that's fine. I'll do that as soon as the show's over. All right. All right. Well, let's look at option strat. So I have good glasses and I have bad glasses, just some readers from the drugstore, but these are Ray-Bans and these are no line bifocals. My low line bifocals have been lost for about 2 months, and I've been using my readers, and I've been right up here, and you guys have been noticing. It's probably painful to watch me. I'm sorry. The few times I've looked, oh my gosh. But back here, I can see from back here a little bit better. I need to just chill back here. All right, so let's review kind of a game plan. I was trying to answer my commenters' questions, and I did I didn't do a good job. Let me read this again real quick. Let's try to make sure we cover it. It says, hey, Max, I've been watching your videos for the past 5 days. First, let me say I like the double diagonals where you set the short strike at the expected move and then move the short call and put slightly out. I've been trading double diagonals for a few years, but your way of setting the strikes is an improvement over my method. I am also using and by the way, I got that method I stole that from somebody too. Putting the strike at the expected move, that's the tasty trade way. And then once I started really getting into it and learning some of my own strategies, it makes a lot of sense to sell the expected move for a strategic reason. We'll get into that. But anyway, so he's saying he's been doing it for a couple of years. He said my way's better. Like I say, it's not my way. I got it from Tasty Trade. I've got everything I do pretty much from Tasty Trade, SMB Capital, my own experience. I've done this 40 years on my own, or from my experience on the other side of the desk, filling orders for people that were, when I was a broker, I did it for a living, but the other side. So anyway, so I've seen it a lot, but I definitely don't have all the answers. Okay. So it says a few questions. You've done several variations of the double diagonal as the example above where the strikes are at the money and then you move the short call or put out where you sell a put spread to finance a long call. Okay. One thing is selling the put spread to finance the long call. It's not the same as the double diagonal. I've done the double diagonal, but I haven't done that one in months. Because for one thing, the selling put spread to finance a call spread isn't calendarized. So these are non-calendarized trades just from a strategic purpose. I do like the double diagonals. We'll do some more double diagonal earning trades next week. But for now, everything in the same month, I'm just copy trading Jay. We're selling a put spread to buy a call spread like he did in Netflix. I don't know why he didn't keep that up and do that consistently. I don't know why he went back to the old method. But in any event, I was hoping when I saw that trade, I was hoping he was going to do all of them. I was hoping he was going to make a max convexity fund, or that's what the way I think of a fund. That's all I ever want is I want a chance at unlimited upside, but I don't want unlimited downside. I want as least amount of risk as possible. I want an income. I want defined risk, and I want a high probability of success. I don't want to do trades every day that have a 20% chance of success. I want to have a lot of winners. So anyway, so I guess I'm trying to answer the question. So how do you decide which setup to use for earnings? Okay. Lately, I haven't been doing the calendarized versions where I do a double diagonal. Lately, I haven't been. We'll do that next week. So lately, what I've been doing is I've been selling a put spread to selling two put spreads to buy one call spread. And how I decide, I don't decide what to do. I always do that one. I show other ways to move the legs in case somebody has a different opinion. I'm not trying to tell you guys what it's going to do. I'm trying to show you guys how to make a plan no matter what it does do. If you aren't, I just by default am long something, the stock and earnings, and then hedge it with Q puts in case the market crashes. Or what I'm really afraid about, I wonder if Google missed really bad and caused the market to crash. That's why I'm, now sometimes what can also happen is Google can miss bad enough where I'll lose the $1,000 or whatever, but it won't make the market crash. And some, so the Q puts will lose too. There's no guarantee that the hedge will work. Lots of times you lose on the hedge, or sometimes you lose on the hedge and on the primary play. But my idea is, either of these, it's going to be a great week, and most of these stocks are going to have good earnings and stay relatively stable, and one or two of them might even blow out earnings. And that's great. Or it's going to be a bad week, but I don't know that going in. But then if it's a bad week, like a really bad week, those Q puts would be worth $3,000 or $4,000 and would offset the losses on the earnings. That's the idea. Or like wonder if Planeteer missed earnings yesterday, caused the whole market to crash. The put spreads would have been actually worth a lot more or potentially more than the Planeteer trade. So that the recent way of doing it, I don't really choose. I just always put on something bullish and then hedge it with something bearish. But lately, my go-to method for bullish is, like I said, a bull put spread. I thought about not showing the methodology on this because I have friends that say I'm working too hard. I spend like 30 hours doing this, and and other influencers get money. And last month, this most recent month, since I started doing a lot of option content and got a Discord, I'm not even going to get any Google money. You have to make $100 in clicks. The way I used to do my thing, where I just made a bunch of video review videos and stuff, I would make about $200 a month just off the clicks from you guys watching just kind of the videos and commenting. Well, as soon as I got a Discord and I started hanging out in Discord and doing option trades, now my clicks have gone to like a quarter. I'm not bitching about it. I like it. This is better. I'm just trying to reorganize my business, and I'm trying to look for, or try to reorganize my time. What I'm thinking is if I can find 10 or 20 people and we'll meet every morning, we'll probably do live streams, or I'll do it live. We'll watch the market open, and that pay me, it would be worth it financially. And then I'll start concentrating more on that. At the same time, if people aren't that interested, I can only find 2 or 3 people. I won't make that much money. I'll gradually stop and I'll lose interest in it, and then I'll try to do something that's a more efficient use of time. I mean, I can talk about anything, but I think that the option stuff is kind of my forte. But the thing that people don't realize is I'm trying to teach you guys how to be good with options, or I'm trying to teach, we're trying to learn together, right? And you guys are teaching me a lot too, but a person that understands all these concepts I'm teaching you and understands how all this stuff works, the high yield ETFs are no problem. You can take a look at the prospectus. You understand exactly what they're doing. You know what kind of, and that's what my review videos used to be more concentrated on the ETF and the option strategy. But so now we're kind of trying to learn how to do some of the concepts ourselves. I thought about putting out some content on, well, I don't want to do that. I'm not going to say that because I don't want to complicate. Let's see what else. I want to show you, we're going to look at the Q put spreads, and then I'm going to let you guys go because the market's getting ready to open. Or maybe I should give you guys a free trade since you watch this. Gosh darn it, I have too many damn freaking tabs open. You got to be kidding me. All right. Some people are more interested in they just want a winner. Let's just try to find a. All right. Disney, that's before they open today. So Lilly, Roblox, Hershey, Honeywell, Bristol Myers. Let's see, maybe after the bell. Qualcomm, ARM, MicroStrategies, Ford, Aflac. I mean, you want to try MicroStrategies? All right. Well, anyway, use your own judgment on whether or not to put this on. Say, I have no idea on any of these if the stock's going to hit earnings or not. And I don't think anyone does. But a lot of people, some people think they're good at picking stock. If you're good at picking stocks and you don't think one of these things is going to hit earnings, by all means, don't do my bullish earnings trade. I'm trying to show math. I'm saying, like, I don't know if it's going to hit, but this is going to put me in a good spot math-wise. If it does hit, and then if it doesn't, and the market crashes, then I'm hopefully going to be able to make some of it back on the Q puts. But anyway, okay. So let's say somebody is a bull on MicroStrategies. What I was going to say though is I've shown how to do this spread so many times. I should have probably. I'm not very smart about this. I should have kept it a secret. I've shown you my exact methodology. I've shown you guys where to hit the strike. I mean, the other thing is you don't have to pay for my service now. You've got it all for free. If you're a good option trader, and I've done that, the same thing you guys are probably doing to me, to other option traders. I'll be on somebody's channel, and I'll watch it enough to figure out what the heck their little thing in life is, and then I'll research it and see if it's if it's interesting, then I'll incorporate it in my strategy. All right, so like I said, I probably shouldn't. I've basically given away the store. I'm just not very good at marketing. All right, so I'm not going to tell in the future. I'm not going to tell how to do this. I'm just going to do it silently. But anyway, you guys can watch me and set it up. And there's not just one way to do this. I want to write a Python routine to give me the best combination of three options. There's a combination of, if anyone knows Python, let me know how hard. I've heard it's not that hard to learn. I've heard that you can have Gemini code for you, or Gemini is Google's AI, and you can get in Google Sheets and you can have them fix your sheets and stuff. Now, I mean, but I would really like to write a routine that just spits out there, maybe the three best combinations that, I'll figure it out. But anyway, I have a routine in my head that I do, and I'm not going to give that out. I have a manual way of figuring out the best combination. Gosh darn, you got to be kidding me. All right. Lots of times, just a little hint, lots of times, see these green lines on option strategy. You only get these when you pay for it, but this is the volume. Lots of times when you have a high volume strike, it's also where the expected move is. I mean, sometimes it is or close. Let's see. Well, actually, this is way past it, though. So these are... Oh, but no, it's not. The expected move at expiration is... Yeah, the expected move at expiration is about 380. So that time it did not work out. But look, the 380 strike is also... The 380 strike is huge. And really, the 375 strike has the most open interest up there. Lots of times they're gunning for those strikes. Sorry, this is kind of boring. Okay, there's your trade. Well, I don't know. Now we're going to adjust it. We're going to adjust it some more. All right, that's your trade. This one's expensive. Don't do this one unless you're bullish on micro strategies. And I can do this because I already have hedge. If I did do this, I'd be all right because I'm aggressively hedged in my account right now because I put on hedges to hedge Spotify, or not Spotify, the Google trade, which didn't work out. But so that can also hedge this trade. So I could do this. What do you guys think? Of course, we could do it the opposite way if it's going to miss earnings. Anyway, I'm probably not going to do this in real life. Use your own judgment. We'll hit save trade and we'll just look at it. So we're hoping that hits, but if it doesn't, it says third rollout, but the first one wasn't a rollout. I just took profit off the table, but I have 2 Q put hedges. That one says that's rollout number 1, and that's rollout number 2. It's really not the third rollout. And trade number 1 was a $358 winner. So we're doing all right on put hedges so far. We're up 358, but we're down 141 on this one, and we're down 80 on this one. So we're still up about 100 right now on put hedges, but we may get, who knows? We have 3 more days, and the market could always sell off. I gave you guys a Spotify trade. There it is. It's a winner. But I also gave you the PayPal trade. There it is. It's a loser. I put the PayPal trade in freaking Discord. I didn't have any content on it, but still I put it in Discord. So it's a loser. So anyway, but of the ones I had content or put in Discord, Spotify's a winner. PayPal's a loser. Google, the jury's still out, but maybe by Friday that will squeeze out a win. We'll see. Not if the market crashes though, but if the market crashes, I might be all right also. So, when I say crash, I don't mean, if we open down 2% the next morning or something, I'll be able to take off those put spreads for a nice profit. I'm not really playing for, I shouldn't even say that the C word. So anyway, so we don't know about Google yet. And there was a third one. Oh yeah, Planeteer, which I gave you guys, which was a wonderful trade. $733 winner, which some of you guys did do, I've heard. And anyway, that one was actually up more than some people took that. It was actually possible to take it off for 1,000. Watch this. This Planeteer, what is it? Bullish loaded dice. Okay, you can hover over this right here, or I guess you click on it. Okay, then right here, it shows you an equity curve of the option trade itself. As soon as the market, or no, that's a 2:40 p.m. between, it's overnight. We came in, that's right. That was between Friday, or no, that was after earnings. I'm sorry. So as soon as they announced their earnings, this trade jumped up and was worth 464%. I just remember in dollar numbers, it was a 4-figure winner. It's more than $1,000 winner. But then it settled down a little bit. But anyway, so let's see. So Planeteer was a $700 winner. Spotify's a $2,000 winner. So that's 2,700. PayPal was we'll call it $1,000 loser. It's down 800 or 900, but it can probably lose a little bit more. At this point, I've already lost about all the money I can lose. Max loss is 834, and it's down. It can only lose 50 more bucks. Okay. If some miracle happens, even if it just goes up 11%, but in 3 days it can, the war's over in Ukraine. Boom, the war ends in Ukraine. The market goes on a 3-day rally. It could happen. So you only have $20 more to lose, but you potentially could make a lot more. And don't forget, you have unlimited upside if it really goes high. So yeah, we're just going to leave this one on, but this one's probably going to be an $800 loser. Okay, well, that sucks. And like I say, we'll see how Google came out. But anyway, between the four of them, you guys should be up. And if you did my put spread, we should have a put spread on so we can, if the market crashes here, it's a way to add a little alpha late in the week. I actually kind of what I hope for is, and the reason I did this in 2022, this worked a bunch. Trump wasn't president in 2022, but I was doing a similar strategy with Microsoft and Apple, and it worked a lot because volatility was elevated and going higher lots of times. And it was because we were in a bear market. We aren't in a bear market. For whatever reason, we have a condition where volatility is just staying really big. So anyway, all right, I'm going to get out of here. All right. Well, hit me up in Discord if you guys want to talk. All right. So the MicroStrategies trade, I guess please don't anyone do that and lose $2,500. I just hate these big trades where it can miss and you can lose. I like the ones more where you risk 1,000. Okay. Let's say you have $1 million. 1,000 is 1% of your net worth. I'd rather lose 1,000. Just if it was me and I had $1 million, then I would rather lose 4,000. But people who are betting 4,000, they're also, if they're playing bigger, they have bigger wins also that can help offset it. But I just believe in keeping these things to about 1% max risk on any one trade, about 1%. Actually, not 1%, 1/10 of 1% of your net worth. In other words, you'd have to lose 1,000 times. I'm not going to lose 1,000 of these earnings trades in a row. All right. But that's the kind of the way I do it. So I like the ones where the max risk is a little bit lower. So that's why I did AMD yesterday. Well, that one's going to be, I didn't show that. Luckily, I did like an hour-long show yesterday and did not release the show. Thank God, because both trades I gave as an example are losers. I forget what they are. I think it was Google and AMD, and they're both going to be losers. All right, guys, I really am going to let you go this time. All right, see you.